For the first time in 13 years, the Reserve Bank of India's balance sheet has seen a rapid rise of 30% plus to Rs 53 lakh crore in 2019 and 20. The size of country's central bank balance sheet is now 26% of the GDP. It was in the region of 20% earlier. Globally, the size of the central bank balance sheet have grown big time in the post-2008 financial crisis due to a very large bond buying from banks and financial institutions. Facing a broken financial system and falling growth, the central banks had to resort to unconventional measures like quantitative easing, as they had exhausted their conventional means like cutting interest rates to infuse liquidity and stabilize the financial system. As a result, the balance sheet of advanced economies, which used to be 10 to 12% of the GDP before 2008, has scaled up to over 20% in the last decade. In some countries, the rise was much more. Take for instance, the European Central Bank's balance sheet size today is 50% of the GDP of the Eurozone countries. Similarly, the US Federal Reserve's balance sheet size is 32% of the country's GDP today. The India's central bank balance sheet size is also moving in that direction. The reason being falling growth, RBI's policy of keeping the system in surplus liquidity, and accumulation of foreign currency assets. So how a central bank balance sheet look like? Like any corporate, the balance sheet of a central bank has two sides, assets and liabilities. The major liabilities of a central bank are currency in circulation, government balances or the government's current account with the RBI, deposits of commercial bank, and also the capital. The currency in circulation or the currency issued by the central bank is the major item with 70% share in the total liabilities. The assets of a central bank include foreign exchange and the domestic assets purchased through open market operation. The foreign currency holding and gold are the major part of the asset with over 2/3 share in the total assets of the RBI. The domestic asset generally constitute 25 to 30%. Over the years, the RBI's balance sheet has grown at an average rate of 10 to 12% annually. In fact, the recent big rise was in 2011 and 12 when it grew by 22% plus. The last big jump in the RBI's balance sheet was in 2007 and 8 when it rose by 46%. That was a time when the economy was growing at the highest rate and the country was also attracting huge foreign capital. So what are the big risks or dangers of RBI's expanding balance sheet? The RBI's balance sheet has increased by 30% plus at a time when the GDP or the output hasn't increased at the same rate. The nominal GDP was less than 8% during 2019 and 20, whereas the RBI's balance sheet has grown massively by 4 times. Any economist will tell you that any sustained rise in the reserve money or the money in circulation can be inflationary if there is no corresponding increase in the GDP. There is a fear in the market that the RBI's balance sheet size would expand further because of a likely recession or a debt monetization or printing of currency by the RBI to support the economy. So far, there are no evidences globally of high inflation post the 2008 balance sheet expansion. But completely ignoring the possible inflation danger would be a bad policy move for a low middle income country like India. Inflation is like a hidden tax on poor and also impacts the middle class savers the most. So far, the RBI's balance sheet growth has been driven mainly by the foreign currency assets. These foreign currency assets are low yielding since the short-term interest rates are at near zero level globally. This high proportion of foreign currency asset also exposes the RBI's balance sheet to market risk. A fall in the value of foreign asset because of a depreciation in US dollar or rupee appreciation against the dollar would bring huge losses to the RBI. Bimal Jalan Committee, which decided the RBI's surplus capital issue, had earlier raised the issue of mark-to-market losses in the Forex portfolio. The report said that in the past, mark-to-market losses of 1.1% to 1.5% of the GDP have been experienced during certain periods. At the current rate of GDP, we are talking of a possible losses of Rs 3 lakh crore, which is a big amount in case the rupee appreciates or the dollar depreciates. The rising dollar reserves also have other negative implications. The RBI, in its annual report, has warned that if the foreign capital is not absorbed in the real economy to finance investment, it can lead to upward pressure on the exchange rate, overheating of the economy, and also create asset bubbles. Currently, a bulk of the foreign inflows are hot inflows into the country's stock market and debt market, whereas the country needs more stable FDI to create assets and employment. Finally, the government also earns dividend from central bank in terms of surplus generated by the central bank in a year. So the composition or the structure of a central bank's balance sheet also plays an important role in generating revenues and profits for the central bank. This year, the RBI has paid less dividend than the budgeted because of its falling income. While there are no set rules for an optimal size of a central bank balance sheet in respect of its GDP, financial system, or in relation to economic cycles of boom and bust, but a large expansion in RBI's balance sheet certainly has implication for an emerging economy like India.